Ethan pays off his mortgage early. James keeps his 30-year mortgage. They both think they made the smarter choice. They're both right, and they're both wrong. Because neither of them looked at the full picture. And when you actually run the numbers, the answer is way more complicated than either of them expected. Let's keep this fair. Ethan and James both earn $150,000 a year. They both want the same house, a $500,000 suburban home. Same neighborhood, same builder, same floor plan. 3 bedrooms, 2.5 bathrooms, small backyard, 2-car garage. They buy on the same day. The only difference is what they do after signing the papers. Ethan hates debt. His strategy is simple: pay it off. Every single month, he sends an extra $1,000 directly toward his mortgage principal. Rain or shine, no excuses. His friends love the idea. Imagine owning your house before 50. No mortgage payment, no bank controlling your life. You're buying freedom. And honestly, it feels good. Because every month, he can see the number going down. The debt is disappearing. James sees things differently. He doesn't hate debt, he hates being trapped. So he keeps the standard 30-year fixed mortgage. $400,000 loan, 6.4% interest rate. His principal and interest payment, about $2,500 a month. After taxes, insurance, and HOA, his total housing cost is around $3,100. Ethan? He's paying an extra $1,000 every month. His total housing cost, around $4,100. That's $1,000 more, every month, for years. On day 1, James's bank account feels bigger. His monthly payment feels easier. He has more breathing room. And when he looks at Ethan, he thinks, why lock up that much money in a house? But Ethan thinks something completely different. Every extra dollar he sends is buying a piece of his future freedom. Every dollar James keeps is staying attached to a loan. And that difference compounds over time. For the first few years, Ethan looks like the genius. Every month, mortgage balance drops, equity grows, debt disappears. He logs into his mortgage account and watches progress happen. No waiting, no guessing, no market crashes, just a simple result. The house is becoming his. James? Different story. Every month he pays, but the mortgage balance moves slowly. That's the frustrating part of a 30-year mortgage. In the beginning, a big portion of your payment goes toward interest, not the house. By year 6, Ethan's mortgage balance has fallen to around $300,000. James's balance is higher, about $370,000. On paper, Ethan has around $70,000 more home equity. Everyone around them sees the same thing. Ethan made the smart move. But James has been doing something else. The extra $1,000 every month went into investments. A diversified index fund, assuming a long-term 8% annual return, his account has grown to roughly $90,000. Quietly, month after month. Now the scoreboard changes. Ethan has more equity. James has more liquidity. And those are not the same thing. Year 6, the house starts aging, the warranty is gone, the AC fails, $2,100 repair. A storm damages the roof, insurance helps, but the deductible is $3,500. The families learn something every homeowner eventually learns: owning a house costs more than the mortgage. Then the economy slows down, projects get canceled, companies cut expenses, both men lose their jobs. At almost the same time. Suddenly, the question changes. It isn't who owns more of the house. The question becomes who has more options. Ethan looks at his situation. His house is worth hundreds of thousands, but his cash is limited. Most of his extra money is sitting inside the walls. The money exists, but he can't use it easily. He considers opening a HELOC, using the home's equity, but the bank wants proof of income, and right now, he doesn't have a job. The irony hits hard. The house is valuable, but valuable doesn't always mean available. James faces the same unemployment, But his experience is different. He has investment accounts, cash reserves, liquidity. He can cut expenses, adjust, wait. No panic, no emergency borrowing. And for the first time, people start asking, maybe having the lowest debt isn't always the same as being financially strongest. 8 months later, both men find new jobs. But they remember those months, because money decisions look different when life gets unpredictable. Then interest rates fall. James calls his lender. Because his mortgage balance is still large, refinancing creates a meaningful benefit. His monthly payment drops, hundreds of dollars saved every month. Ethan checks too, but because he already paid down so much principal, the savings are much smaller. The opportunity exists, but it doesn't change his life. Year 10 arrives, college. Both families face the same reality. Their children get in. The cost, nearly $150,000 over 4 years. James uses his investment accounts, not happily, but comfortably. Ethan faces a harder decision. The money he planned to use for college was already sent to the mortgage. The house became stronger, but his flexibility became smaller. Then more life happens. Parents age. Medical bills arrive. Unexpected expenses appear. The same things that happen to millions of families. Finally, year 15 arrives. Ethan reaches his goal. Mortgage balance, 0. The bank is gone. The payment disappears. He frames the mortgage release letter because, for many Americans, owning a home completely free and clear feels priceless. His home is worth around $780,000. James still has a mortgage, but he has built something different: home equity plus investments. His total net worth is similar, just stored differently. Ethan's wealth is mostly in his house. James's wealth is spread across financial accounts. One built certainty, one built flexibility. So who made the smarter choice? The uncomfortable answer? Neither, and both. Ethan wasn't wrong. He bought peace of mind. He bought the feeling of owning his home completely. James wasn't wrong. He bought options. He bought the ability to respond when life changed. Because personal finance is not just mathematics, it's about uncertainty. Jobs disappear, markets fall, children grow up, parents age, unexpected bills arrive, life happens. The biggest mistake isn't paying off your mortgage early, and it isn't keeping a mortgage for 30 years. The biggest mistake is choosing a strategy without understanding what it gives you and what it takes away. Because the real question isn't, should I pay off my mortgage? The real question is, when life doesn't go according to plan, which choice gives me the life I actually want? I'll see you next one.